I'm Scott Starratt with Starratt Wealth Management. First off, Happy New Year, and hopefully everyone had a good holiday season. The markets were definitely in a holiday mood in December. We had another very strong month, so that makes November and December to be very, very strong months for the market, and which is great. We ended up having some significant improvement compared to what we had seen maybe in the middle of the year, and we ended the year for most people off at a very high, at the high point, definitely of the year. It's interesting to note that, you know, with all the positiveness out of a very small number of companies this year, although that it did expand throughout November and December, but with the significant increase in those 2 months, we did see the markets come back to almost an all-time high, especially in the United States, where the seven, or as they refer to it repeatedly in the news, the Magnificent Seven, continued to have a good ending of the year. But interestingly, if we look at the last 2 years, so all of 2023 and all of 2022 and all of 2023, we actually see that the S&P 500, so the top 500 companies in the United States, actually just broke even for the 2-year return. So even though last year was a very good year, a lot of people did forget that we had a very bad year for that particular market in 2022. And so going forward, I think it's important to continue to have, you know, enough exposure into the equity markets to take advantage of any benefits that we're continuing to see in that area. The uncertainty this year is going to be predominantly around at what point does the Federal Reserve in the United States, and to a lesser extent the Bank of Canada here in Canada, start decreasing interest rates. A lot of that is going to depend upon how sticky inflation is. We know now that inflation has definitely dropped to between 3 and 4%, depending on what measure you use. And although that's very positive for the overall market, the Federal Reserve and the Bank of Canada continue to say that they want inflation around the 2% range. So that does mean that there is a ways to go before we do hit the 2%. So the uncertainty comes at what point does the Fed feel that they've done enough work that they can start reducing interest rates. A recent study I saw that was plastered all over CNBC, etc., over the holidays, was basically that a lot of people are calling for 6 rate cuts, a rate cut being 0.25% during 2024. That might be a little optimistic. They're also saying that that could start as early as March. That, like I said, could be a little optimistic, but the point is that we've probably seen the end, unless inflation does surprise us to the upside. We have seen the end of interest rate increases. And so what's that mean to the market? I mean, right now the market and bonds, you know, have definitely improved as the interest rates have dropped. And when I say interest rates, I mean more the bond interest rates have dropped over the last couple of months. That being said, I think the important thing to watch for is the fact that earnings will have to improve, or at least stabilize in the stocks, in order for us to continue to see a strong stock market. We're probably properly valued at this point based on today's earnings of the stock market. And so in order for this to be an improvement that stays or sticks and reaches an all-time high again, I do think that we have to have improved earnings. So what does that mean to your portfolios? Well, we continue to benefit from interest rates being at a higher point. We have put in place, and we continue to have some really good quality managers, as well as some really good quality investments that are taking advantage of the interest rates. We typically find that most of the managers are still generating between 7 and 9% on an income basis, and most of the other investments in the portfolio on the bond side continue to perform quite well. On the equity side, as I said in the last update, we've had the most equity exposure in the market that we've had for quite some time. That's really benefited us. As a matter of fact, we for a lot of people had the Canadian Bank index, a levered Canadian Bank index in the portfolio that we happened to buy at almost the perfect time. That's up over 20% as of right now. So, you know, we've had some significant improvement, and we hope that that improvement continues. That being said, we continue to be weighted more towards the safety side of the portfolio. In other words, having more money in bonds, having a little bit in cash, and continuing to have exposure into the defense bucket. And so what that would mean is that as the interest rates come down, or as the equity market comes down, we're in a position to take advantage of that opportunity. So over the next little bit, we're going to be getting together, of course, as our regular review situation unfolds, and go through the rate of returns for 2023, as well as some interesting numbers for the 2 years of 2022 and 2023. We're also going to touch base on all the normal administrative stuff we do at the beginning of the year, things like tax-free savings accounts, RSPs, confirming RIF payments, making sure income is suitable and continues to generate for the portfolio. Because we did have a pretty significant outperformance over the last couple of years in the market, in client portfolios, we have had a fair number of clients that are asking about how do you refer clients into us. The best way to do it is an e-invite or an e-introduction, or to just give us a call. Jim, myself, Rimshaw, or Angela, more than happy to chat with you about that. I know this time of year a lot of people are looking at their portfolios, and there may be people that are disappointed that they've seen that really things haven't grown for the last couple of years. And so I just want to say that we're definitely available to chat with any friends, family that you may have that are interested in having a free second opinion on their investments. As always, please do reach out to us if you do have any questions about your portfolio, and we'll be in touch very soon.